Are you struggling with your Australian loan repayments? We know that interest rates have been skyrocketing since the beginning of 2022. So in this video, I'd like to share with you 5 tips or 5 strategies that you can consider to ease the burden of repaying your Australian mortgage. Let's dive in. Hi there, Jarrad Brown here, Australian expat financial planner. Welcome to my video series. In this video today, I would like to share with you 5 strategies that you can consider to ease the burden of your Australian mortgage repayments. We've seen mortgage rates rise from 2% to the mid-5s now. A lot of people are coming off fixed rates, which either start with a 1 or a 2, and those rates are going to be refinanced or to come off those fixed rates and revert to a rate that begins with at least a 5, if not a 6. Naturally, this means that our repayments are going to be increasing. It potentially puts a bit more strain on our cash flow, particularly at a time when rents in Singapore are getting a lot more expensive. So what can we do to ease this burden? Let's have a look at some of the options. So the first option that we have is to consider extending the term of your loan. So let's just say, for example, that you have a loan that expires in 20 years' time. What you can instead do is refinance your loan and extend that loan term out to 30 or 35 years. And you can often do this with a number of lenders up to the age of 75. Now, what it does mean is that you will be paying more interest. It will cost you more over the long run to do this, but it could be a good way to ease the short-term burden of those loan repayments. So tread with caution with that one, but it is an option to ease the burden of the short-term cash flow. So that's option number 1. Let's have a look at number 2. Now, option number 2 you have to consider is to consider going on interest-only repayments rather than principal and interest. Now, interest-only means that you are only repaying the interest. As the name suggests, no surprises there. It can be a very tax-effective strategy, but you do need to consider if there is an interest rate differential between the P&I rate and the interest-only rate. Some banks will charge you more for interest-only rather than P&I, whereas others won't. So make sure you do your homework, make sure you're not overpaying by going interest-only, but it is another way to reduce your monthly cash flow or your weekly repayments by having interest-only repayments rather than P&I. So that's number 2. Number 3 is to utilize your offset account in Australia. Now, this could be a very good place, particularly as interest rates are higher now, to keep your emergency fund. So if you have 3, 6, 9, 12 months of your expenses saved up in cash in your bank account and it's not already in your offset account, it could be a very good time to shift either all of it or a portion of it to that offset account. Now, given that it's an emergency fund, make sure you can still access it from wherever you are in the world. We don't want to be locking that away into a structure that's incredibly difficult to access, but it could be a good way to make sure that that emergency fund is delivering us with a reasonable rate of return. Option number 4 is a relatively simple one and maybe easier said than done, but that is to take advantage of the low Australian dollar. Relative to the Singapore dollar, we're at a rate of about 1.12 to 1.13 at the moment. So we're getting an 11, 12, 13% uplift on every Singapore dollar that we transfer back to Australia. So if you're waiting for 114, 115 or some arbitrary figure simply because we got there last year, it doesn't mean that it's coming. Whilst we expect that the Australian dollar will remain relatively soft, it doesn't mean that the exchange rate is going back to those previously seen levels. So this again could be a good way, topping up your offset account, reducing your loan balance with your Singapore or US savings. So that's option number 4. And option number 5, which I would urge you to really err on the side of caution with this one, but it is a potential option to ease the short-term burden, is to simply release some of the equity in your property to assist with the cash flow of your mortgage. Now, it sounds almost a bit counterintuitive to increase your loan to help with your loan repayments, but it could be a good way of effectively managing that cash flow over the short run, particularly if you are facing some short-term cash flow issues, you're waiting for somebody to go back to work, if you've seen a drop or decline in your bonus, and that's going to be relatively short-lived, this could be a good way to plug that short-term gap and get yourself through without having to sell. As always, seek some advice with this one. Property contains very expensive transaction costs, so if we can avoid selling and avoid getting hit with tax or unnecessary fees, obviously we would like to do exactly that. I hope that's been helpful. I hope that gives you a few options to consider if you are facing some struggles or challenges with your Australian mortgage. Drop me a note with any questions you've got, but thank you for tuning in.